Hello, it's Big Chuds, and this is part of the Trading Encyclopedia Daily Education series on my YouTube at Chuds Trading. You can find me on Twitter at Big Chuds and Bitcoin Live, where I'm a founding analyst. For today's lesson, we're going to talk about a bullish rectangle. It's also called a box in Japanese candlestick theory. You can pause and read this on your own time. I'll show you a couple images to get an example. You have a move up. Here's another one. Hopefully you can read this a little bit better. Price moves up. We have a range peak, a range trough, and then a breakout. Now in this image and a couple of the other ones, it talks about buying on a break of the top and your stop loss in the middle. I don't like that, and I'll tell you why in a second. So a bullish rectangle is a continuation pattern. It's continuing to move up, so that's the trend. Trend is moving up. Set to range peak. Set to range low, peak, low, peak, low. Well-defined range peak, well-defined range low. Now, this can actually also be called a bullish flag. As we know, bull flags can be downsloping, they can be sideways, or they can be rising. But these are two parallel lines, essentially forming a supply level at the top and a demand level at the bottom. Now, you can play this a couple of ways, but here's what I recommend. Now, in classical charting, you want to be trading with the trend, which means you should be looking to take a long at the bottom of the range, or taking a long on a break of the range peak, rather than attempting to short when the price bounces into the range peak. And here's why. The price is more likely to continue at any point. It may not even form completely, the bull rectangle or the box. It may not give you all these multiple time points. It may just give you one and then break through in the second attempt. You want to be going with the trend, which means every move down here is a move against the trend. Move against the trend. Move against the trend. So these minor trends are moves against the broader or the primary uptrend here. So you take a long at the low, and you can take a long in the breakout. Now, with all consolidation patterns as well, of course, you start out with the highest volume in the advance, and normally volume will slowly trail off until the consolidation range completes, and then you get a break of the volume trend, ideally with a break in the direction. So a bullish rectangle, go ahead and you can read this as well. Read this again. This actually talks about the stop loss below the support level down here. What I would do if I took a long in this break, I'd have my stop loss right here. If I took a long on this low, I'd have my stop loss nearby. I would define my risk as being right near that level, because the propensity or possibility of coming back if you break out. If you don't hold right at the top, you're going to test likely the entire range all the way down. You don't want to hold all the way back down to the trough. But this is a bullish rectangle or a box in Japanese candlestick theory. And this is for the Trading Encyclopedia Daily Education series on my YouTube at Chuds Trading. Find me on Twitter at Big Chuds and Bitcoin Live, where I'm a founding analyst. Folks, thank you so much, and I'll talk to you soon. Big Chuds out.